I'll cover a couple things in price action and then how to use the open and close to determine the next draw on liquidity. So the dollar index, okay, we're going to cover that first. Left-hand side, obviously, we like to look at it on the daily chart over there. And then the 5-minute chart is on the right. And I'll get over to the lower time frame in a moment, but I want to spend a few moments on this higher time frame chart. Okay, and we were looking at how price made its way up into this old buy side imbalance, sell side inefficiency. It went to the upper end of it, pierced it by a little bit, spent a couple days inside of it, and then gave up the ghost and went lower. When the dollar index is going lower, that gives a green light for index futures, forex pairs that are dollar based to rally higher. So in other words, it's not a guarantee. It just means that if you do get very strong technicals that indicate a high probability long in those markets, and I'll kind of classify that today when we get to Nasdaq. Everything I'm going to tell you today is applicable to all markets, but bonds and obviously, when we're looking at the dollar index, it's a barometer. We don't trade the dollar index, but we use it to indicate whether or not there's some underlying bullish or bearish tone that's underneath. Okay, it's some kind of under the surface credibility that we can establish behind when the market's on a risk on, risk off basis relative to the direction that the dollar's moving. Dollar rallying higher, going up, is risk off. That means everything else, if you have a sell signal that's high probability, you're probably looking at something that's going to work out. Not a guarantee, but it really qualifies a high probability condition for a short. But as you can see, the dollar index made its way lower than that low and worked outside of this suspension block into this candlestick's wick and all the way down to consequent encouragement of this old inversion fair value gap. You can see how the nice reaction off of that came right back up, and we just fell short of reaching the low of the suspension block right in here. Okay, but the question is coming up that how can we determine where the market's going to draw to next, and what are we doing with these wicks? Why do I pick this one wick over another? When I'm looking at price action, okay, if you're not going to pay attention to this kind of discussion, if it doesn't interest you, if you don't like going into the details, I promise you everything that you study under me will frustrate you. It's not meant to be easy because it's very technical. But what I'm going to explain to you here is very generic approach to every single time I'm looking at price action. My mind frames out a specific area in price action. See, when you look at this chart, you're looking at all of these candlesticks and you're looking back. You're like, okay, where's there a fair value gap in here? Where's there relative equal highs? Where's there a wick over here? I'm not doing that. So what I'm doing is I want to see, okay, first if the data range is 20 days look back. Okay, so what would that look like? What would that constitute as a beginning and ending point, so that way you have a very easy framework to start and hit the ground running this week. That way you can go and start using this information yourself. We are on Saturday. So this is looking at the close on Friday. Okay. Count that day as one. So right here, September 22nd, that's 20 days look back. Now, inside that range of 20 days, what we're going to look at is the highest high and the lowest low. So what would that be? This is the lowest low, and this is the highest high. So in deference to those two price points, but inside this range, that is my 20-day look back. That's all I ever need. I don't ever need to look to 40 days or 60 days. But if we're looking at just tell me what the market needs to be focused on right now, what PD arrays are going to work right now, which one's the central focus, what draw on liquidity is the ones that I need to be worrying about right now. Give me the right now skinny ICT. This is what I'm looking for right here. This is my bread and butter when I'm real quick, kind of like sitting on the sidelines, waiting for something to pop up. My go-to is this. So I want to go back over the last 20 days. if it's a running trending market like gold is, okay, then I'll go back 60 or 40 days and I'll get the range there. Okay. And what I do is I want to see where are we in relationship to that range. Now, obviously, right now we're in the premium side because we went down to discount below. Here's this dark line here. That's 50% of that line. So at this line or above it is premium, or at this line below it is discount. Okay. So having all these reference points inside this range available to me, I first start fresh by looking at where are we in the range of that segment of price action. By having this, it tells me where I can focus in on very high probability shifts in market structure, where it can draw down to as a retracement, and what PD arrays lie inside of each one of these quadrants. Because every one of these quadrants also can be graded. So the extremes, when we get into these areas here, when we have a 20 look back that's bullish or has been moving higher like that, unless I'm expecting a complete reversal or basically a bear market resuming, I'm not looking for anything in this lower area down here. My focus is going to be primarily in this area here and this area right in here. All the setups, all the things you're going to look for that are many times just actionable PD arrays that you can just get in there and just take a trade on intraday, 1 minute chart, 5 minute chart, 15-minute chart. You're going to see all kinds of busyness available to you as a short-term high frequency trader. And forego the idea that it needs to get down this extreme lower quadrant. Now, inside of all these quadrants, there's going to be PD arrays, okay? And those levels, with their respected grading levels, I have those in order. So, but every PD array in here and its respective quadrants, like this wick in here, I would have that written down below this price level here, and it would all be listed from the highest to the lowest of what I'm looking at. And then I'm watching price. We're looking at this range here, and inside of this portion, okay, 75, 50 to upper 25%. That is where the heart or the core of most of everything you're going to see that's useful to you, it's going to reside inside that. So that way you can ignore this area for now until it comes all the way down to the lower quadrant and breaches on a closing basis. You need not concern yourself with anything down here. That's how I'm interpreting price action using a 20-day look back. So I'm focusing primarily on just this bit of business in here. Okay. So with that said, we're going to remove this now, and I'm going to remove this box and go back to what I had here. Okay. So we were up here, and I told you if it went down to this level here, then it would offer the opportunity for NASDAQ to go higher. And when we're up in this level here, using that idea that I showed you on the 20-day look back, it allows you to frame a very specific segment of price action. So your focus is narrowed to what is the most salient range of price action that the algorithm is going to refer to at the moment, 20 days look back. By grading that, you can see where the upper quadrant and the lower quadrant, in deference to the equilibrium price point, inside that little area, or maybe not necessarily a little area, it could be a broad, big area, but inside that smaller portion of the last 20 days look back in dollar, all of that is going to be the heart of what the market's going to utilize. And you need not concern yourself with anything beyond that. So do you see how right away we're already reducing the argument down, okay, and distilling the principle of focus by limit your focus to the upper quadrant and the lower quadrant in the last 20 days, whether the market's moved higher or lower, you are now focusing in on where every single one of the high probability PD arrays are going to form. Do you see the advantage in knowing that now? Every single time you sit down in your charts, and what will be interesting for you is by you going back and back testing. How would you do that real quick before I go on further? Let's say that you were doing this, okay, and you look back. This is the 20-day look back range here, but you want to do another research approach to it. Well, just move further over to the back of the old price data and just pick any random day and start there. Say, okay, I want to do a case study here. Let's say I was looking at price action here and count that as day one and go back 20 days and frame it and grade the range from the highest and the lowest, and then see where you're at and look at the upper quadrant and lower quadrant. And you're going to see everything that's being used is inside those very specific ranges. So that's what the algorithm's doing. It's cycling through on a daily chart in that range, highest and lowest, because it's an algorithm. That means it has to go back to a very specific data point. By having the reference to time, we can look back 20 days, highest high and lowest low, and then frame where in that range the algorithm is going to focus on primarily to use specific data points. On a daily chart, every individual day and its open, high, low, and close is a specific data array. It's a reference point. Now, what do you think happens when the algorithm is looking when we're up here? It's going back through all of this range. And we knew that this area in here is essentially the upper and lower quadrant, not the lowest extreme quadrant and not the upper extreme quadrant. It's just the middle part. Okay. While it's up here, if it's going to go back through every individual candlestick, it can determine, like this candlestick here. This is a premium wick when price is right here. If it's going to reprice lower for the purposes of allowing other markets to go up and create a risk on environment and trade to a deeper discount on its individual daily range, it would not use this candlestick premium wick because it's already below it and it plans to go lower. It's generating more delivery to the downside. So it's going to ignore this candlestick wick. But what will it do with, for instance, this wick? This is a premium wick too. Let me move it over so you can see it. See that? So this candlestick's high is delivered with a small little wick. I want you on your own time, take that wick right there and project those quadrants all the way through and look at every small little time frame, see if there's any rhyme or reason to why price maybe abused any of that. Then the next one after this candlestick going to the left, in the look back of 20 days, it's going to be up here and then looking, oh, now look, this candlestick has a daily high and then its close is way down here and its open is down here and its low is a tick or so below that. So you can see visually that there's a long wick on the top end, right? So the algorithm is going to take that entire range of that wick and what's it going to do? It's going to grade it. And then projecting those quadrants forward, the algorithm right up at this day, the rules I told you is if it goes down below consequent encroachment and goes below this individual candlestick low, then NASDAQ's going to go higher and dollar will want to go trading lower. And then we'd have to worry about going into this inefficiency and worry about this wick here. Go back. You just let them believe whatever they want to believe. But if it's up here and it trades below that, the algorithm is going to have all these levels immediately because it knows this old day had a high and the close was significantly lower below it. It's open what's below it, and then the low is here. So it knows the orientation. So it knows how to grab this candlestick's high and this candlestick's close. It's a very short little order of coding that's required just to get the idea of each individual time reference. And anybody that's looking at candlesticks that are not time-based, you are literally wasting your time. And you need to warm up to the idea that these markets are using time, and it's using it just like this. Knowing this candlestick had a higher premium wick, stripping it down to just the quadrants. The close, the high, and every quadrant that's equal quadrants, lower quadrant, equilibrium, upper quadrant, and a high. That's the price levels that the algorithm is going to refer to. Look at the 5-minute chart right here, okay? I'm going to try to squeeze this area there. Now we can see it. So here at Thursday, the 16th, that's this day right here, okay, on the daily chart left-hand side. On the 16th, we were above it while we were inside that blue suspension block. It starts to trade down and leaves that blue shaded suspension block. And then here's the high of that wick over here. So it's encroaching on that wick high when we get down to 98.499. Right here, we hit it. We drop a little bit from it, come back up. Fair value gap, fills that in, drops. Fair value gap, fills that in, drops. Where's it drop to? That's just the upper quadrant of this wick. Trades down to it, creates your little classic bull flag. It works then, doesn't it? It drops down to this equilibrium and then has some kind of random reaction, like a rash, or hives. It starts to bubble up and goes right to some random level, the upper quadrant level. Right away, this should get your rocks off. And I'm sharing this with you because I want you to do these things in your own chart. Because every single meaningful price run, don't take my word for this, every single meaningful, significant, valid price run, and there's always valid price runs occurring all day long, every time frame, they all originate off of this idea. Because this right here is the foundation, it's the spinal column that holds all of the efficiency in price runs using my PD arrays and the efficacy of how I use them and when I select them. Because if you strip this away, there's no rhyme and reason why I would use any other fair value gap or any other PD array, any other order block. There's no way for me to determine which one it's going to use. This is it. This is the thing. This is the sauce. This is the secret. This is the whole fucking shebang, baby. If you understand this, they can never, 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 not a fucking time in the fucking future can they ever hide it from you. They can never fucking hide it from you. Now, can they have some crazy manual intervention where they whipsaw back and forth? Sure, you might lose money on that. You might get stopped out. You might take a big loss. But they can't keep doing that. Every day can't be a fucking seek and destroy up and down this destroyer because nobody will trade then. Price trades up to this in here, trades right to the order block that's laying right there. Let me make it a little bit bigger for you so you can see it. See that little up close candle right there has a volume imbalance in it? Trades right up into that. It's the open of that price. So there you go. Hits it. Why does it drop? Because it's an order block? No. It's because my order block is stacked over top of and laying right on that quadrant. What quadrant is this? This premium wick array, upper quadrant, right there. And it drops. Stops dead on equilibrium. And then it stays inside no man's land. Whenever you see price hovering between quadrants, don't touch it. That's when you're gonna get burned. That's when your fair value gap is gonna not be so pristine, not so helpful. It'll be unruly and price will trade outside of it and through it. We open lower, trade down to the lower quadrant, this one here, and then trades down to the old inversion fair value gap right here on the daily chart, left-hand side. So the market trades away from this down to the lower quadrant, down into the inversion fair value gap again. Bodies are respecting the inversion fair value gap high. Again, that's this area right over here. This candlestick's close to this candlestick's open. That's what I'm shading because this is originally it's a suspension block. But when it trades above it, it's going to invert its characteristic. So it's an inversion suspension block, but it's inversion fair value gap. Suspension blocks are in the category or classification of a fair value gap. But the upper quadrant used here trades down into the inversion fair value gap, which is this candlestick's close. Trades to it and through it. Okay. Now, when we look at the market when it's in a deep, deep discount, we're looking at this at a time when we're now in the lower quadrant of the last 20 days look back. And we're real close to getting into the meat or middle part of the lower quadrant area. So we want to be referring to where we are on the daily chart, what PD arrays and what levels are there. And you start on your daily chart and then have those levels transposed over into your lower time frame, like for instance, like your hourly chart and the 15-minute time frame, submitting to the time that's required to learn and learn properly. But if we're in a deep discount down in here, we start now waiting for markets to indicate a shift in market structure. Here is a big, big light year jump ahead, okay? To give me a grade. If this is useful information that you can see, wow, this is really precise. I can see how this would really help me pick PD arrays. It would help me determine where the draw on liquidity is, where all this is coming together based on this structure. This is the skeleton behind the PD array matrix. Having all these things documented on your chart is useless without this information. This is the like the decoder ring. Okay, it's the cipher that you use to determine what the rhyme and reason is for the market at this given moment. That's what this is. So when we anticipate a market potentially going into a shift higher, after it trades down to a deep discount here. We went right down into this level here that's 50%, in case you're wondering why this did this. This little 50% line is half of this inefficiency right here, from this candlestick's close and this candlestick's open. That's what I've highlighted and shaded. That's the suspension block. But this indicates that we're in a deep discount and we're inside of a daily old inefficiency, and the market's traded down. And then now we can start studying price to see if it wants to give us a tip of the hand, kind of like show its cards to us by wanting to go higher. And that's going to be in the form of a market structure shift. You can see the bodies are respecting. We got a little bit of a wick in here. And then we have that short-term high formed right there, right on top of the low of this candlestick's premium wick. That's this candlestick's closing price. This short-term high, when it pierces through that, that's a shift in market structure. Now, to get in the market there, that's a very high risk because you're basically trying to pick the low of a move. Try not to do that right now, okay? So when price pierces above this wick high, why am I picking that one? Because after this low formed, it started going back over top of this lowest quadrant, and it pierced a swing high in price. That's this candlestick right there. See that? So when it traded above it right here on this candlestick, we want to start seeing what? Bullish order flow. When price trades above that swing high, we want to start seeing price do two things, okay? Every down close candle supports price. And I'll explain what that is in a minute. And we also want to see it respect the quadrants. Price goes above, the bodies come down here, but there's a little piercing on that candlestick right there, the wick, and right there. Where are the bodies? Are they above the lower quadrant, or are they allowed to go through it and trade below it? They're above it. Big, 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 big indication right there. The candlestick bodies are staying above it. So that's giving you the narrative that we are now in bullish order flow. This is all that's necessary to understand what order flow is going to do. It tells you when it should start being bullish. It tells you how to trust that it's being bullish, how to identify it. The bodies are saying we're not going to go lower. So start watching down close candles. Do down close candles support price? Because that's my order block. My order block is not fucking orders. The word order is that it's ordering the change in the state of fucking delivery, okay? That's the technical fucking term. It orders. It coordinates. It has nothing to do with buying and selling orders. Watch. Down close candle right here. See that? What we want to do is visually represent, in my mind, I'm looking at that opening price and I'm carrying it to the right. Two things you have to primarily concern yourself with. Fuck the level 2 data shit. Fuck everything else. Fuck all your gimmicks. Okay. Everything you need to know is time and price. And by having these quadrants on your chart, or at least knowing what they are, then what you're doing is when there's a potential shift in market structure, how do you know it's a shift in market structure, Michael, and not just a retracement that's going to sell off later on? Watch. Watch. We're in a deep discount on the daily chart right here. This thing should, even if it's going to be a short-term bounce, it should at least make an attempt to rally outside of this inversion pair Vega. In and of itself, that's enough to take a trade. That'll give you 10, 15, 20 pips in pound dollar, euro dollar. But looking at the down close candle, it's the lowest one, not just this one. This is lower. This open is lower than that one. It has nothing to do with the number of orders. No buying and selling orders have nothing to do with this. That opening price is the change in the state of delivery. The order, the word order, is going to order, it'll create the systematic shift in price at that level, at that fucking price, that one. That's what you're looking for. When price is dropping down into it, like right here, okay? This candlestick's opening price is 98.143. And this candlestick's 98.142. It's off by 1/10. And it's the dollar index, which is shit. It's a market that's not real pure. Dollar's always got this weird, quirky bullshit to it. But when you use it with an index like NASDAQ or S&P or Dow or Russell 2000 or bonds or forex currencies or currency futures. But watch what happens when it trades down into that. Then now what's it going to do? It orders what? The change in the state of delivery. The block of time sets and establishes the order in which price will change its state of delivery. That is the real definition of my order block. Hot and fresh. And then the market starts going higher. Now watch. We go above this lower quadrant. Okay. Big shift. Okay. Big shift is coming. Are we seeing price come back down to that quadrant level? Yes. Does it wick through it? A little bit. And that's permissible. But this candlestick, this candlestick, this candlestick, this candlestick, this candlestick, that is a block in time. You pay attention? That opening price is the order block. That's the change in the state of delivery. That price, carry it forward. We rally a little bit up here, we fall short and start to break lower. This is the next draw, but it's going to drop back down into this order block. All of these consecutive candlesticks is one order block. Now, when you have a series of down close candles, you can go to the lowest one and be very restricting on your selection of setups. You're asking for the best of the best. There's nothing wrong with that inherently, but it just means that you're going to miss some setups if you're only and always doing that. But when you have a range of candlesticks like it is here, let me make it a little bit bigger and taller. So by having that open on that candlestick down to that close here, here is the upper quadrant, the mean threshold, the lower quadrant, and the low of that order block. All these consecutive down close candles, you have to consider the entire range. You can't just, oh, I'm going to only pick that one and expect to get every move. You won't. You won't get every move. You grade it. You want to see it stay in what? The lower half for um, the best responsiveness and price action. Do you want to see it appear in the lower half of it or in the upper half of it? What do I teach with order flow using my PD arrays? When it's bullish, we want to see equilibrium or halfway mean threshold. You want to see consequent encroachment or up to the high of the PD array. When it's bullish, you want to see sensitivity in there. And when it's bearish, you want to see it stay in the lower half. You don't want to see it traverse down into this area down here. And since we can measure this, watch, here's a qualifier for you. This is going for the people that ain't here really trying to learn, this is going to go right over your fucking head. The open is right there at the equilibrium price point. So you're demanding it must go down halfway. What would happen if that opening price was down below that? It's even less likely it's going to trade to that as the order block. So now I just taught you when there's a series of candlesticks that make up an order block, how do you use the information? This is how you use the information. So it goes down to the upper quadrant here, wicks down and touches the upper level of that inversion fair value gap. So we're getting two things. It's using the order block. It's staying in the upper portion. So it's inside of this order block. It's this line and anything above. So this is the range right here. That's what you want to see it use. But it trades down and just touches the inversion fair value gap on the daily chart. So you're getting two pieces of information here. Yes, it's trading inside of this entire order block. It's permissible to do that. It could go all the way down to mean threshold, and that's completely perfect. There's nothing wrong with that. What you don't want to see is trade down in the lower half of that. In other words, below this on a closing basis, because then your probabilities of seeing a price run higher, it falls off precipitously. You want to see it stay in the upper portion of it, from mean threshold up when it's a bullish order block, from the low up to mean threshold, the lower portion when it's a bearish order block. Okay, so those rules are pretty straightforward. All right, so I can take this off now. All right, and then we get the change in the state of delivery. It rallies back up, falls short of getting up into this wick here. This is a premium wick, but you can grade that and carry it over here. And then it trades right back down into the upper quadrant of this premium wick. Market reacts, comes back down to the upper quadrant. Does it respect it? Yep, sends it off again. Comes back down, wicks into it again, little tiny coloring outside the line, but watch the body. This body stopped here. We opened here, traded down. When it trades live and trades down like that, you want to anticipate it do this very thing here. And you want to see this candlestick or immediately the one following that. In other words, say this candlestick closed anywhere but below this black line here, the upper quadrant. If it closed anywhere like that, the next candle we would demand, okay, because I supply, and I, I demand respect for the stuff I'm sharing. That's the real supply and demand right here. The idea would be to expect the candlestick to start raging higher like that because it's already showed a willingness to come down here a couple of different times, and now it enters a macro. What time is that candlestick right there? Look at the bottom of your chart or my chart. 6:50. Man, that's random. That is absolute fucking bonkers, man. The timing of that run off of that quadrant after the shift in market structure I taught you how to validate, you're in bullish order flow. All the things are sitting there telling you it's respecting the quadrants and down closed candles. Series of order block. Does it support price? Yep, it rallies. It's in it again here. It rallies off the quadrant and then it tags it one more time. And now it's time to run. We're entering what time of the morning? 7 o'clock to 10 o'clock. That's the time of the day. I told you every fucking day it's going to lay it down on you. Here's the opportunity on a silver platter. Like, what do you call this? If this is not timing the market, what is it? This is exactly what everybody says is impossible. What the hell? So anyway, it rallies off the macro and then trades all the way up to that random level of equilibrium price point or consequent encroachment rather of the wick. Trades up to it here. It comes right back down. And what's it doing right here? What is that? Buy side imbalance, sell side efficiency, BISI, and watch. Order block. Changing the state of delivery. Carry the opening price over. It trades right down into that candlestick's opening price. Hammers it. Does it respect it? Yep. But those relative equal lows, Michael. I have to hold some things back. I wouldn't be ICT if I wasn't. So anyway, price sends it here, and we trade through the consequent encroachment level. And then now watch again, we're above it. And it comes right back down. Are the bodies telling you that order flow is still bullish? Based on what I just taught you. Very simplistic language, very simple. When order flow is bullish, the quadrants and down close candles support price. In other words, treat that as your real support and resistance. That's the shit that really works. Does it support it? Yes, it does. Can you see it trade just a little bit above with these two wicks? Yep, and that's permissible. Why? Why is that permissible, ICT? Explain that to me, because I would be nervous if it was trading down here like that. Well, what is this? It's a fair value gap that's laying directly on top of that consequent encroachment level at 98.306. That's a high probability. Ready? High probability fair value gap. Okay. You're seeing him. You are seeing the maker. Okay. Here it is. The bottom line is that it runs right back up to upper quadrant, trades through it, falls short of the upper level at 98.499. That's this candlestick's wick high. And then it starts to retrace. Do you freak out? Do you lose your mind? No. Here's where you have a change in the classification of what is permissible and what's not permissible. When we are in the lower half or at consequent encroachment of this kind of wick on the daily chart, the lower portion of it, that's where the real pure, you demand that the rules must be followed. They cannot deviate. They can't have any kind of, well, coloring outside the lines. It has to show you the support. The down close candles and the quadrants must be supporting. But when we get on the upper half up here, what happens is the price will and many times go into like this area of consolidation. Then you'll see stop hunts. You'll see using retracements that go below a short-term swing low, and then the real move ensues after that. But that will occur from consequent encroachment level up to the upper half or the high of it. That being this candlestick's premium wick. Okay, so from here, yes, from the consequent encroachment level of 98.306, this is a run that is favorable. But once it originates here, we shouldn't expect with any kind of fear that there's going to be retracements to that level after it's already done this type of parabolic run. But the retracements that occur in the upper quadrant, they can come back over top of that upper quadrant, even though it's listed as 0.25. It's because it's this level here. Bottom line is it trades down through it and then back above it and then rallies up to the high here, then back down. Now, This is the stop hunt I was telling you. It's always going to occur in the upper half. Here's consequent encroachment. Think about if it's going to move, chasers are going to see, oh wow, look, it's running now. Dollar's probably bullish, and they retrace it. They lay a trap down. They show a breakout above this old high. They're not using this quadrant level. They're looking at this high being broken out to the upside. And then they see a bull flag. They say, wow, I'm going to keep adding there. And then they shit the bed and come right back down for their stop in the upper half. How does ICT know when they're going to do a stop hunt? How does he know when it's a market structure shift or just a stop hunt? I just showed you. By having these ranges graded, it pulls back the veil and shows you exactly what it is that you should understand about what's permissible and what's not. What should and shouldn't happen. Stop hunt taken, supporting at a quadrant, yes. We wick down through it. Why is that permissible? We're in the upper half of a bullish order flow. Volume imbalance. Volume imbalance right in here. You see it trace right down to that little inefficiency right there. It doesn't need to go below that low. For the folks who are saying, why would you be afraid it's going to go below that? Because it's already done that. Right there. That's the stop hunt in the upper quadrant. There's the little stop hunt. Boom. Leave a volume imbalance below the quadrant level. Rally, it gets a little muddy in here. They use this inefficiency here to send it right back down just to get that volume imbalance and scare anybody else that maybe has a stop loss here or they think this is a big bear flag. And they would chase it going lower. And then it resumes back to supporting the quadrant. And now watch, we have another run away from it. After it's done this only inefficiency down here, we go back to looking at the order flow with the order block. Down close candle, opening price, draw it out. Is it supporting it? Is it staying in the upper half of that? Yep. Rally. And it runs up to the high of that wick again. NASDAQ 2025. All right, daily chart here. 2 Fridays ago, we had this really big sell-off. Because we have a large gap here between these 2 price points, where we closed 2 Fridays ago, and then where we opened the new week there. That's the new week opening gap, okay? And we traded into it here, and because of the previous Friday, it dropped so far down in there, and that gap still remaining, that there's gonna be a strong interest for price to wanna go back down to that in the eyes and hearts of traders. Like, they wanna see that happen down there, but if you blend in what I said about the dollar index, if it was to go lower on its daily chart, then it would cause the NASDAQ to go higher. So that's you taking what I said about what retail would expect, okay? Like when I'm talking about opening range gaps at 9:30, where we open at 9:30 opening, and where we settled at the previous day at 4:14 p.m. Eastern time. Those 2 price points, you have to have those mapped out on your chart. Price need not fill in that gap the day it forms, or even the week that it forms. It could do it weeks later. Just because they gap doesn't mean they must fill right away. And the same thing here. It is such a huge gap, and it's baited people to anticipate it going down there and continuously going lower. Look how many times they offered that here, here, and even went lower there. So at this point right there, I'm sure everybody at the time thought that this thing was going to go down to there and lower. But that's exactly how they're using that range that they created 2 Fridays ago. They created a killing field. It's like a landmine field, okay? So you have to use every single day's wick, grade them and carry them forward. Know where the opening price is and closing prices of every daily range, the high and the low, and that's how you navigate in this. That's exactly what you have to do. And if you watch what I was showing you this week, that's what I was focusing on. I was pointing your attention to those very things there, not look for it to kick out Friday's low from 2 weeks ago. Staying inside the range. I mean, we stayed, well, before I do it, think about what I taught you in this lecture here. Think about what I just said about grading the range. hopefully none of you could disagree that this is the range that we're inside of 2 Fridays ago. That's the range. So it's this. Until we get above or below this individual day, we're trading inside the range. And it's defined with that shaded area. That's the range. Okay. But inside that range, there's quadrants we have to be concerned about because that's what the algorithm is going to refer to. Inside of this big range of price action, that is that's the most significant one. We don't need to go all the way back 20 days. This is the elephant in the room. This is it right here. So we have to leave that range before anything else is useful. Do you understand that? I'm not I'm not saying that 20 days ago's look back period for if the data ranges isn't um, useful here. I'm saying that even before we get to that, this is what we have to concern ourselves with because this is the biggest range that we've not moved out of yet. So as a trader, until we leave this range that's defined here, we're going to work around like we've been doing all week. And if you don't like those types of environments, then just take a couple weeks off. I'm not teaching buy a breakout and sell a breakout, but I'm telling you, wait for that band of volatility to be taken out. And now we have exploration into a higher all-time high, or we're resuming the damage that was done on that Friday. I promise you, what I just said here is very, very crucial for you to understand how to behave as a trader going forward. And by knowing this, we can now grade it. 2 Fridays ago's high, and that's doing the same thing that we would look at with the 20-day look back, the highest high and the lowest low. If you ever have a big event like this, start there. And then when we leave this range, then we can go back. Like if it goes below here, then go back 20 days and then use that range. And it'll make much more sense to you. Okay. Scrunch this up. And that's these levels here. Okay. All right. So look at this response down here. It's respecting the lower quadrant and then rallies up. What did I teach you about grading ranges like this? Inefficiencies, PD arrays, gaps. What did I teach you? The meat, all the things you're going to look for is going to occur at consequent encroachment or midpoint, okay, to the lower quadrant and up to the upper quadrant. Inside this area in here is where 90% of what you're going to look for as a trade is going to form all the time. And when they occur with individual inefficiencies and wicks, and those quadrants are forming new PDAs around in that, you're going to get the best setups and best things that deliver. So you're not going to, let me put it this way, you're not going to waste time looking at things and thinking they're PD arrays, and they're really not. They're not high probability. So if dollar went lower, and we can all agree that it went lower, the filter was going to be if it went lower, then the NASDAQ would start to go higher and make an attempt to try to challenge going into the upper end of this band of volatility that was created on 2 Fridays ago. We traded down to the lower quadrant of that previous Friday's range here, and look how it gave up and went all the way back up there. Again, we went down to it again here just to take out that low, and then look at the reversal all the way back up and closed up higher. What is it showing you? The logic, what I told you, when you're grading these ranges, when you're bullish, the lower quadrant to the consequent encroachment, that's going to be the meat of where your big bullishness is going to come. Yes, on the wick part or portion on a daily chart, it's going to have a little wick down here. But if you're looking at it on the lens of a 5-minute chart, you're going to have candlestick bodies down there. So you have to permit things from a higher time frame daily chart. In other words, if it was doing the bodies closing below that quadrant on the daily chart, that's a problem. We don't want to see that. But having the 5-minute chart here, having candlestick closes and the bodies below that daily range here of that lower quadrant of the Friday to Fridays ago's range, that is not disturbing anything. You're going to have to allow for that to happen. And that's just simply understanding the continuity between one time frame to the next. What something looks like on a higher time frame chart as a wick is going to have lots of candlestick bodies on the very, very low time frames. And that's just something you're going to have to get real used to understanding and expecting. It isn't going to create a wick on a 5-minute chart like it does on the daily chart. because it has to spend time booking price down there. Whereas on the daily chart, like that's a pretty good amount of handles to offer, and not just do it on one little flash of here's one price above 24,466, and then one tick it only goes down to the lowest low, and then it leaves it again above it, and that means you'd have a wick only on the 5-minute chart. That's not going to happen. If you expect that to happen, you're going to be frustrated. So just be comfortable with knowing that bodies below this level here, when it looks like a wick over here, expect bodies to form on the lower time frames. When it's a wick, you're expecting on the higher time frame. I want you to see this uh, consequent encroachment of previous Friday's week range from the low up to the high. We graded that. Okay. The consequent encroachment level right here. What what was dropped on top of that? What's this? Isn't that a bullish fair value gap? See that? The market drops down into it, gives you institutional order flow entry drill, which is a partial fill of the gap. It's a high probability fair value gap because it's laying over top of a quadrant. What do I mean by laying over top of? If this, say this is your candlestick, okay? Have a quadrant level, and the next candle that's immediately formed after this one does this. And the candle prior to this one looks like, pay attention to this part, okay? I promise this is going to clear a lot of your confusion up. If this is the quadrant, you want to see any portion of this candle that makes the actual gap or the fair value gap, it needs to be laying on top of this line. So you would naturally have it viewed like this. So that's your normal ICT bullish fair value gap. Okay, crude depiction, but it's accomplishing the method. So in here, you know, this will be a high probability fair value gap if it trades back down into it in the future. If we see a quadrant and it's laying like that, this is not a high probability fair value gap. Can it be used? Yeah, it can. I'm not going to use that one myself. Okay. If this quadrant looks like that, that is not a high probability fair value gap by my terms. So it's not a smart money fair value gap. It's just the common gap. Common gaps, they can stay open and they can fill in. There's 50-50. I'm teaching you my language to determine that if the quadrant is like that, right on the low of the fair value gap, that's a high probability fair value gap. If it lays just on the high only, like that, that's a high probability fair value gap. Why? Because the candlestick that creates the fair value gap in and of itself, that range, is laying over top of and crisscrossing like a crosshair on the sniper rifle. That is where you're aiming. You see that? Big light bulb moment. Okay. It's going to hit one that gives you the theory that I'm teaching you. And then when it matches, and it matches during a time window, open, okay? If it's in the first 30 minutes of the opening range in index futures, and it lays on top of a quadrant like that, man, that's high probability, huge probability. If this happens to be the first percent of fair value gap, and it's laying on top of a quadrant of the opening range gap, new day opening gap, new week opening gap, previous day or close proximity candlestick premium wick or discount wick, and I taught you how to find them. Looking at the daily chart over here, see, I'm already teaching more shit. This is what happens. And I know you love it, but I'm never going to get what I want to get done now. But this wick here is the highest one of all these. So you want to grade that one and carry it forward and watch how price is utilizing it. And I'll show you what I mean. Wildly precise and profitable. All right, so we have this Thursday of this past week. Here's the opening on that daily candle into the high. All right, so we have the low, which is the open of that candlestick on Thursday, right here. All right. And I'm going to take the opening range line off here because it's already got too many things on it. So these are your quadrant levels. Lowest one in here, no gap. That was immediate rebalance. And here we have fair value gap there. And what time is it? 2:20. Is that the right time? Is that a time that I teach you to use? I know there's a lot of people out there teaching all kinds of weird shit, but that's not what I teach. So that is not the right time. That fair value gap, you would carry it forward. Excuse me. All right. So here is macro time 250. We're inside of it now. Okay. The bodies are respecting it now, isn't it? Do you see what's happening now? Over here, it can color outside the lines with the body, but now it's time. Excuse me, it's time. We're in the 250 to 310 macro right there. Okay. The next candle is laying right on the low end of it. It opens and closes at the next candle right at the low. Okay. Big paradigm shift. Ready? 250 starts right there. Right there. Quadrant level tells you that that's the price, but that's not the time. They have to agree. Entries must occur on time and price. This is a fair value gap is laying on top of that previous wick. Okay. And it's trading at the this one here on Thursday's wick. Creates the fair value gap on that quadrant. That's the one you annotate and keep going forward with it. Keep extending it to the right until you get to a macro time. And that is 250 rather. Starts the macro time from 250 to 310. Does the candlestick start respecting that fair value gap? The bodies are staying inside of it. This is permissible. And the body comes back and closes inside the fair value gap. Opens, trades down to the low, just one tick outside of the range over here by the fair value gap. But notice what the bodies are doing. It's respecting it now. And all the way up to 310 there. It's used it there as well. See that? That's what I'm talking about, having the quadrant levels and then determining what PD arrays, and you can do this with order blocks too. It's not just a fair value gap phenomenon. I'm only showing you the fair value gap because it's visually pleasing and aesthetic. It's easy for you to see it. It just jumps off of the chart versus all the down close candles or all the up close candles. It's a whole lot more to choose from when you ring in the order block. So that's the reason why I chose to start with this idea of the structure behind the premise of why the PD array matrix even works is by having these quadrants on your chart and then looking at these things and then saying, okay, I now have a fair value gap that's valid by price, but I can't do anything with it until it's time to trade with it. So this means here is your macro time. So in between the start of it here and the end of it there, okay, you have a chance to be a scalper. Okay, what time of day is this? It's the last hour trading the PM session of the New York market. Okay. So that is a scalping environment. It's not a big wild run of a type of day. It's limited. So you have to pick your shot, know what it's reaching for. Okay. So if you want to be a very, simple surgical striking type of a trader, you use the 250 to 310 macro, find a quadrant. If you have a fair value gap laying on top of it like that, or a suspension block, something to that effect, you now have your price. Keep carrying it forward until you get to the macro time. Then when that happens, you have to look over to the left side of what price has left you in its wake. When it got down to this level again, what has left in price actions to the left side of the chart? Relative equal highs. Now, is this a high probability candidate for a run on liquidity? That low is lower than that high. That's a valid ICT candidate for a run on liquidity. That's Candyland. So you can buy the low in here. Every time I tap that low, you can buy it there. You can do the quadrants on that fair value gap in and of itself. So here's the low, and then look at the bodies. Look how it's respecting that lower quadrant. I mean, really, look at that. Look at that. Look at the bodies right there, laying on that. It drops and touches the quadrant there. But there's no, I'm sure Wyckoff has something that we can attribute to. It doesn't really. But the bottom line is it runs up, and now look at the bodies respecting the what? Consequent encroachment, the midpoint. Look at it. Look at that. Then it rallies up, trades outside of it, and comes right back down into the upper quadrant. And we want to see it now treat this range because it left it. What's the expectation now? Do we want to see it trade down into consequent encroachment and trade in the lower half after it leaves it like that? No, we do not. No, we don't. It can come down in the upper half. Worst case scenario, it touches consequent encroachment, but it needs to do so on a wicking basis, but preferably not at all. Upper quadrant, the bodies are hinting, look, it stays off of it. See that? The next one here rallies up, comes right back down, comes to the high end, doesn't touch the upper quadrant, and look at the body. It's not touching the high of it. That's a signal. That's a little artifact that the algorithm leaves behind for smart money to identify. You can't find the things I'm telling you. These signatures are not found in footprint. They're not found in volume analysis. It's not found on level 2 bullshit. It's not found in anything else. Open, high, low, and close on a time-based fucking chart. That's it. Time inside this window that's marked here. Price is here. You determine both have to agree over top of a quadrant. Is that complicated? Relative equal highs. Last hour, it's only a scalper's market. Run up, take the liquidity out. You have a quadrant here and a quadrant here. If it's the last hour trading, do you want to see it rip and run? No, you're not expecting that. You just want to get a small little piece, surgical strike, like a cookie cutter shark. There's a shark out there in the water that literally is a little bitch that runs around, finds something bigger than itself, runs up against it, slams into it, boom, hits it, and its mouth is a perfect circle. It bites and runs away, and hopefully it runs away, and it lives to do it again. And that's how it eats. You are a cookie cutter shark in the last hour trading. That's all you're doing. This is the shark. This is the whale. This is the other bigger fish out there. All you're doing is running from the logical level of entering to get that liquidity, get that little bite of it. That's it. You're done. You're done. If this was forming in the first 30 minutes of trading, you are not doing that. You can take something off there to make sure you pay yourself, fund the trade, then let it rip. See how you have to use some characteristics and changing of your thought process from one time of the day versus another time of the day. And the reason why it's like this is because if you're looking at the daily range over here on Friday, you opened here, traded all the way down, and then up here. So you're already in the last portion of the day. The likelihood of this thing careening up to make all-time highs, not likely. It's not likely to get up to Thursday's high either. It's a lot of range to do in 1 hour. So you're looking at the power of 3, which is the open, high, low, and close formation, which is open, accumulate, manipulate, distribute. AMD, power 3, it's the way the candlesticks formed its daily range. You're trading in the last portion of the day. That's not when the biggest portion of the move takes place. The biggest portion of the move is between the first 30 minutes of trading at 10 o'clock in the morning up to 2 o'clock in the afternoon. Don't take my word for it. That's the lion's portion of the daily range every single day. Unless you see a day like 2 Fridays ago where that's a totally different animal. But generally, the distribution of the volume of the daily candlestick's body, the range of the body of the candlestick, that's formed between 10 o'clock in the morning and 2 o'clock in the afternoon. And usually anything after 2 o'clock is just the small continuation of what's already been done since the opening bell.